Global Real Estate Bubble Index 2025. As you know, UBS, a famous Swiss financial institution, issues its index assigning the bubble risk rating to the top 25 cities in the world. For 2025, it positions Dubai from the previous moderate level to the elevated risk level. Now, it raises three main questions. How does this rating work? And what is the underlying methodology they use? And if their methodology really applies well to the local dynamics and the ground realities of Dubai. But more importantly, what are the five main data points in the report that raise serious questions and concerns about the fair application of this rating for Dubai? Let's dig deeper. So let's start from here. What is price bubble? A property price bubble is a situation where prices rise significantly higher than their true value, generally because of speculative buying and selling. And mostly and usually it ends up by a sudden decline. So the way they calculate these ratings is they apply two fundamental methodologies. One is valuation methodology, whereby the property prices in a given city are assessed against the local income and the rental trend. Then they utilize the economic distortion methodology, whereby mortgage to GDP ratio is assessed as well as the construction to GDP ratio is assessed in order to assess the overall exposure of the real estate market to the economy. So the first technique they use is price to rent ratio, because it tells how many years it would take to repay the cost of same property. For example, in Zurich, as per report, it takes 43 years rent to pay the cost of the similar property, which is equal to just 2.3% of annual rental yield. But still, investors and buyers are buying and selling it, most probably based on speculation that prices will further increase. Now, this 2.3% is way below than the average interest rate in emerging market, but still investors are buying it. So it gives us an indication that the prices are artificially being inflated, whereas in Dubai this price to rent ratio is 15 years. That means buyers are not buying on the basis of speculation, but based on property's ability to produce a decent rental yield. That's where most of the demand is coming from. And the second technique that UBS uses to assess the risk level is to understand property price to local income ratio. What that means is how many years of average income one person would take to buy a 620 square feet apartment within the close proximity of city center or downtown. In Dubai, it's only 5 years, whereas cities like Hong Kong, it's 12 years plus, London is 10 years plus, in Zurich, it's again 12 years or plus, which means the housing prices in Dubai are way more affordable. It's not just that. What this UBS report not considers is that in Dubai, major demand comes from the international buyers, those who does not live in Dubai, but due to various motivations, for example, as a store of value, as a safe haven, as a rental yield friendly asset, and sometimes as a matter of prestige, people buy property in Dubai, and according to various projections, this ratio of international buyers buying properties in Dubai is above 50%. That means the demand for properties in Dubai is not based on local income level only as it would in the mature markets, for example, London, New York, Zurich, Miami, or other cities where this formula can better apply, but not in Dubai because its fundamentals are totally different. The third major technique it applies is to assess the mortgage to GDP ratio to understand what is the overall exposure of the housing loan to the GDP. Again, this formula cannot apply to Dubai, where most of the transaction up to 80%, I mean there are credible data sources to find out, up to 80% buying is in cash. So this particular technique does not tells us that there is an elevated risk, because in that way There is absolutely no risk because most of the transactions are happening in form of cash. The fourth technique UBS uses is to assess the construction to GDP ratio. Now again, Dubai real estate market has evolved big time. Now developers rely more on payment plans than the loan from banks. So that means it's basically the end users or the real investors who are funding this construction. So its exposure to GDP actually does not matter. Fifth contradictory point in this report is that after adjusting the inflation, property prices in 2025 in Dubai stand exactly what they were back in 2014. Now, what does that tells us? That property prices are actually undervalued, not a bubble risk. For example, let's understand the different asset classes and their prices back in 2014 and in 2025. You talk about equities, S&P index, you talk about gold, you talk about crypto. Everything is way more higher as compared to 2014 than now. Also, as well as the income level of the households and the businesses has gone way more higher during the last 10 years. Whereas this report itself says that the property prices after inflation adjustment stand same as 2014 level. That means there should be enough room for it to catch up the other asset classes. So we can safely claim and argue that Dubai real estate market is nowhere near the bubble. Dubai's elevated label may reflect model error rather than objective risk. I hope you liked my video. If this is the case, never forget to like and subscribe my channel. I only create the content to research and bring the real and value information for you. Thank you.